A better solution for managing these loans, better than deferment and forbearance, I think, is an income-driven plan. The reason is because under income-driven repayment, you can have an affordable monthly payment tailored to your income and your family size, and you get on track for loan forgiveness. So you can have, hopefully, what's an affordable monthly payment, and then under all of these plans, you don't repay your loans under these plans within the requisite time period, which is usually 20 or 25 years, depending on the specific plan the borrower is eligible for. Any remaining balance gets forgiven at the conclusion of that term. Contrast, a borrower who is in forbearance can't make any progress towards anything. You're not paying off the loan, so you're not making progress towards loan payoff. In fact, the opposite is true. You're just increasing your balance. And you're not making any progress towards loan forgiveness, whereas under an income-driven plan, you are. There are also poverty exemptions under the income-driven plans, so that if you're earning zero or you're earning somewhere around the poverty line or below, you might actually pay nothing. So it's effectively like a deferment and forbearance in that no payments are due for those borrowers, but at least here, again, you're making progress towards something. You're making progress towards loan forgiveness. And while forbearance and deferments are time limited, 36 months apiece during the lifetime of a federal student loan, income-driven repayment can be renewed every year, every 12 months, until the borrower reaches loan forgiveness, which again is at 20 or 25 years. So you don't have to deal with the same the same concerns necessarily as you would with a deferment and forbearance, with the exception that interest is still accruing during these plans, but there's at least that safety net of loan forgiveness. So diving into the details here in terms of the specific plans. I'm going to start with income contingent repayment just to stay at the beginning. ICR is not going to be the best plan for most borrowers. I'm going to talk about it because it's going to be the only plan available for certain borrowers, but more to contrast it with the newer, better plans that have since come out after ICR. But they all function fairly similar. So for ICR, ICR uses a formula. That formula is 20% of what they call discretionary income. Now, discretionary income is not what you or I might think discretionary income is. It's not, all right, here's what's coming in, here's what's going out, here's what's left, that's my discretionary income. That's not what it is. Discretionary income, as defined for these programs, is the amount of your adjusted gross income as reported on your federal tax return that is above a certain poverty exemption. So put another way, from zero in income to the poverty exemption cap, the borrower pays nothing, and then it's a percentage of the borrower's adjusted gross income above that exemption. So for ICR, that percentage is 20%. ICR is only available for direct loan borrowers. I mentioned before the distinction between direct and FFEL program loans, why that's important. This is one of the reasons. Certain plans under the income-driven umbrella are only available for direct program borrowers. ICR is one of them. So ICR has a 25-year repayment term. I have a little asterisk down there that says taxable in terms of the forgiveness event that occurs at the conclusion of that 25 years. Under current law, loans that are forgiven under income-driven repayment plans are, the Department of Ed says and the IRS says, are going to be treated as taxable income. That can really be a big deal for borrowers who are able to have affordable payments and then are going to get hit with a big tax bomb at the conclusion of that 25-year period. The reason why I have it asterisked and with a question mark is because no one has reached the 25-year mark on any of these plans yet. So we can't say for sure how it's going to be treated. There are already proposals in Congress to fix this, and 25 years is a long time and a lot can happen. So I think that it is going to be a taxable event for some borrowers at the very least, but I'm cautiously optimistic that we'll see some sort of change, but I don't know if and when that's going to happen. So right now under current law, it is going to be treated as taxable income, but with the caveat that no one has actually received forgiveness under these programs yet. So to give you an example, in terms of numbers here, a borrower who has $50,000 in eligible federal student loans with an adjusted gross income of $40,000 and a family size of 1, their payment under the ICR plan would be about $445. ICR is the least generous of the income-driven plans, so it's not going to make sense for most borrowers. I'm just going to use this as a as a way of contrasting it with the other plans. The exception here is that Parent Plus borrowers, so borrowers who have federal Parent Plus loans that they took out for their children's education, Parent Plus borrowers are generally not eligible for any income-driven plan. The exception is Parent Plus borrowers who consolidate their federal loans through the direct consolidation program can place that consolidation loan on the ICR plan. ICR is the only plan that they can get access to, and only if they consolidate. And so that's really the only reason I think why ICR still exists, is because for some Parent Plus borrowers, it's the only affordable plan that's available. So income-based repayment, or IBR, this is the most common income-driven plan. It's probably the one that you've heard of. It's the most widely accessible. It's available for both direct federal loans and FFEL program loans. It's not available for Perkins loans. It's not available for Parent Plus loans. It has a better formula than ICR, whereas ICR has a 20% formula based on discretionary income. IBR has a 15% formula, so it's cheaper. It also has a larger poverty exemption. For ICR, the poverty exemption is 100% of the federal poverty limit for the borrower's family size. For IBR, that exemption is 150%. So there's more income that's excluded from the formula, and then it's a lower percentage of income that's counted above that exemption. Has the same repayment term as ICR, 25 years. And again, we're dealing with the same possible tax consequences of the forgiven loan balance. But look at this payment figure. Single borrower, family size of 1, same loan amount, $50,000, same income of $40,000. IBR payment's going to be $280. That's a lot better than the $445 under ICR. That is a significant difference. For both ICR and for IBR, if the borrower is married, the loan servicer is going to consider both the borrower's income and the spouse's income if the borrower files their taxes jointly with their spouse. However, if the borrower files taxes separately from their spouse, under ICR and IBR, the servicer will only consider the borrower's income. So what makes sense for most borrowers, it really is a fact-specific inquiry. Not only will the servicer consider the spouse's income if filing jointly, the servicer will also consider the spouse's federal student loan debt as well. So for some borrowers who are married, both spouses have federal student loans and they're filing jointly, IBR might make sense. For other couples where only one spouse has federal loans and the other doesn't, or where one spouse makes a lot more money than the spouse does, than the spouse with loans, then filing separately might make sense. There's also tax consequences to filing separately, which might offset some or all of the savings that you would see under IBR or ICR by filing separately. So there's a lot that goes into this analysis. What I typically do for my clients is we run the numbers, we figure out what it's going to look like for borrowers under scenario A versus scenario B, and then we have them run a tax analysis with an accountant to see how the tax figures should play out depending on how they file taxes. We compare the figures. If there's a clear difference one way or the other, we go with the cheapest option.